Silver investors, something significant has shifted in the financial system, and it hasn't made mainstream news yet. Today, we received a clear indication that the Federal Reserve is stuck, the national debt engine is spiraling, and the supposedly safe bond market has quietly revealed what most people haven't yet recognized. In this video, I'll walk you through what changed today, why the Fed is now caught between a debt crisis and rising inflation, and what all of this means for silver heading into 2026. Segment 1. What changed today? Let's begin with what happened today, because this isn't some abstract long-term prediction. It's unfolding in real time. In the most recent development, the Fed is now openly discussing keeping interest rates elevated for an extended period. But simultaneously, the bond market is beginning to anticipate future rate cuts because the economy simply can't endure this kind of pressure indefinitely. The yield curve, the gap between short-term and long-term interest rates, has been significantly inverted for months and is now attempting to normalize. But that normalization isn't a sign of success. Historically, it's what occurs just before or during a recession, when the Fed begins cutting rates in response to economic weakness. So what exactly shifted today? The latest bond market movements and Fed messaging are collectively signaling that we've entered a phase where inflation hasn't been fully defeated, economic growth is decelerating, and the Fed has virtually no clean exit strategy without causing major disruption. Whenever that kind of policy trap emerges, safe haven assets like gold and silver stop behaving like ordinary commodities and start acting as insurance against central bank missteps. That's the territory we're moving into right now. Segment 2, the Fed's impossible dilemma. To truly grasp why this matters, you need to understand the corner the Fed has painted itself into. On one hand, the Fed raised interest rates aggressively to combat post-pandemic inflation. Those rate hikes drove up borrowing costs for governments, businesses, and consumers alike. On the other hand, the U.S. government is running enormous deficits and refinancing trillions in existing debt at these elevated interest rates. Each time bonds mature and are reissued at current yields, the interest burden skyrockets. This is the dilemma. If the Fed maintains high rates to suppress inflation, government interest expenses balloon, corporate failures increase, unemployment climbs, and political pressure on the Fed intensifies. If the Fed lowers rates prematurely to ease the debt burden, inflation risks resurface, the dollar loses strength, and trust in fiat currency deteriorates even faster. That's what it truly means when people say the Fed is trapped. Every option now comes with consequences, for the economy, the currency, or both. When central banks run out of clean solutions, hard assets gain strength. Segment 3, the bond market's silent admission. Everyone pays attention to stocks. Serious investors watch bonds. The analysis we're referencing highlights how bond market behavior is now clearly indicating that the higher for longer narrative won't hold indefinitely. The market is already pricing in a future where the Fed is compelled to reverse course to protect the debt framework. The signs? Yields at key maturities have stopped climbing and have begun leveling off or declining. Even while the Fed maintains its hawkish rhetoric, the curve is gradually shifting from deep inversion toward a normal shape. And historically, the transition isn't a positive signal. It's a warning of recession. It's as if the bond market is saying, we believe you'll be forced to cut rates. Not because you choose to, but because you'll have no alternative. Once that view becomes widespread, the long-term credibility of the currency comes into question. That's when gold and silver transition from being trades to becoming escape routes for capital. Segment 4, the debt spiral. Why this is unsustainable? Let's break down the debt situation in straightforward terms. The U.S. isn't simply borrowing more, it's borrowing more at higher costs. Total federal debt already stands in the tens of trillions. Every 1% rise in the average interest rate amounts to hundreds of billions in additional annual interest payments over time. That money has to come from somewhere, either higher taxes, reduced spending, or additional borrowing and money printing. Now add to that, corporate debt that was originally financed at rock-bottom rates is now maturing into a world of elevated borrowing costs. Households are stretched thin managing mortgages, auto loans, credit cards, and student debt, all at higher interest rates. This is precisely why the Fed is stuck. Keep rates elevated and debt service crushes the real economy. Slash rates aggressively, and inflation and currency risks flare up. Either path leads to the same long-term casualty, purchasing power, which is exactly what silver and gold are meant to safeguard. Segment 5, why silver is more than just gold's smaller sibling. You might be thinking, okay, John, that makes the case for gold, but why silver specifically? Silver isn't merely a cheaper version of gold, it's a dual-purpose asset. As a monetary metal like gold, it has historically served as a store of value. It reacts powerfully to real interest rates, inflation expectations, and confidence in currencies. It is an industrial metal, unlike gold. It's essential for solar panels, electronics, batteries, medical technology, and more. Its demand is driven by actual manufacturing and infrastructure needs, not just investor sentiment. So when the Fed is cornered, the monetary dimension activates, investors seek protection. When the global economy pushes aggressively into electrification, solar energy, electric vehicles, and technology, the industrial dimension activates, real-world demand remains firm. That's why silver can move more dramatically than gold in either direction. During fear spikes, silver can surge past gold on the upside. When liquidity evaporates, silver can drop sharply, creating remarkable buying opportunities for those who understand what they're purchasing. In a world where the Fed is trapped, debt is piling up, and inflation hasn't been truly defeated, that volatility isn't a flaw, it's an opportunity, provided you respect the risk involved. Segment 6, the uncomfortable reality. Inflation isn't actually gone. The surprising part isn't that inflation cooled from its peak. The surprising part is that even after aggressive rate hikes, prices never actually came back down. They just increased at a slower pace. The new elevated price level is now the starting point, not a temporary anomaly. Services inflation, including rent, healthcare, and insurance, remains persistently high. So when the Fed claims they're winning the inflation fight, what they really mean is they've slowed the damage. But the underlying problem remains, and the economy is already weakened. Silver and gold aren't reacting to the next marginal 0.2% shift in an inflation report. They're responding to a more fundamental truth. Once purchasing power is lost, it doesn't return. Governments rarely opt for fiscal discipline. They almost always choose more spending, more debt, and eventually looser monetary policy. That's the long-term dynamic where silver thrives. Segment 7, how this scenario typically plays out. If you examine history, central banks caught in this kind of trap tend to follow a predictable sequence. First, the denial phase. Inflation is temporary. The economy is resilient. We'll maintain higher rates for as long as necessary. Then the stress phase. Debt payments start to bite, corporate failures increase, unemployment creeps up, and political pressure builds. Next comes the pivot phase. Rate cuts or behind-the-scenes easing, increased bond purchases, liquidity injections, and special programs. The messaging shifts to, we need to support growth and ensure financial stability. Finally, the consequence phase. The currency weakens. Hard assets and commodities reprice sharply higher, and those who relied on cash savings find their wealth eroding. We're currently somewhere between the first and second phases. Still hearing tough talk on inflation, but the bond market, the debt arithmetic, and the real economy are already pulling us toward the third phase. That's why calling the Fed trapped isn't sensationalism. It's simply a description of a cycle repeating itself. Segment 8, practical implications for silver investors. Enough with the theory. What should you actually do with this information as a silver investor? Here's how a disciplined investor approaches it. You don't try to trade around every Fed decision. You establish a framework and let the market present opportunities. Key principles. First, time horizon. If you're thinking 2 to 5 years out, the relevant question isn't whether silver might dip next week. The question is whether you believe the combination of debt, the Fed's policy trap, and inflation risk will be worse 3 years from now. If the answer is yes, then buying silver at suppressed prices isn't a problem. It's an advantage. Second, position sizing. You never commit everything at a single price point. You accumulate gradually across time and price levels so that volatility works in your favor rather than against you. Third, approach. Some investors prefer physical silver for long-term wealth preservation. Others use ETFs, mining stocks, or futures for additional exposure. But leverage magnifies risk. The more leveraged your position, the more vulnerable you are to the Fed's short-term maneuvers, shaking you out before the real move materializes. Fourth, patience. The system doesn't collapse on your timeline. The Fed will prolong the situation as long as it can. Your advantage isn't in predicting the precise turning point. It's in being positioned before the majority realizes there was never a painless way out. Segment 9, gold versus silver. Which makes more sense? Here, this analysis also involves comparing gold and silver. Here's the essential logic. Gold is the primary monetary metal. It has a deeper, more liquid market. Central banks actively purchase and hold it as part of their reserves. It typically leads during the early stages of a crisis or policy uncertainty. Silver is more volatile, operates in a smaller market, has less central bank involvement, and attracts more retail, industrial, and speculative activity. It often trails gold initially, then overreacts later in the cycle. So in a world where the Fed is trapped, gold serves as the conservative insurance policy. Silver is the higher risk, higher reward play on the same fundamental thesis. For many investors, it's not a choice between one or the other. It's both, with different allocations based on individual risk tolerance. Segment 10, final thoughts. Why today's signal matters. So why am I emphasizing the urgency of what changed today? Because today's developments aren't about a single price candle or one Fed remark. They're about confirmation. Bond market action confirming the Fed's predicament. Debt mathematics confirming that sustained high rates aren't viable. Persistent inflation confirming that easy monetary policy won't come without a price. And gold and silver price movements confirming that, increasingly, capital is quietly seeking an exit from the fiat currency system. If you wait for mainstream media to announce Fed trapped, currency at risk, hard assets soaring, it will already be too late. By that point, the window for easy accumulation will have closed, and you'll just be another late arrival chasing parabolic price moves. If this helped you see the bigger picture behind the daily noise, hit the like button so content like this reaches more people. Subscribe and turn on all notifications. We'll be diving deeper into this in upcoming episodes. And leave a comment. Is the Fed trapped or still in control? Share your view after reviewing the data, and more importantly, explain your reasoning. Because on this channel, we don't chase narratives, we follow the numbers.